if we don't have a market crash, I should be able to retire at 45 in just over 4 years. It's super aggressive. That'll bridge to my pension. In the video, I'm going to talk you through the exact maths behind it, all of the numbers, how long it's taken me to get here, what I have in my investment pots today, what I'll have at 45, and also what that will allow me to draw down. Right, let's get into it. So what have I got today? So I've got two pots that I use for my investment. The first is my stocks and shares ISA, and that's been where I've invested the most heavily because I didn't want to wait until I was 57 before I could start to access my investments in the hope that I could retire before the age of 50. It just transpires now that 45 is that target age that I'm going for. So in my stocks and shares ISA, I have £250,000 just over, which it's taken me the best part of a decade to accumulate, investing every month, paying myself first, which is wild to say. You know, I'm not a millionaire, I'm not a particularly wealthy person, never come from money, and it's great to have that amount in there looking at me now. Tempting sometimes. The other vehicle that I've used, if you like, is my pension, so my private pension, which is paid through employer contributions but also my own, so I've always taken advantage of the matches there, and that has 160,000 in there now, so that brings me to a total of around £410,000, depending on if the stock market's playing ball or not. It's been a little bit turbulent recently, but I'm certainly in that region. I invest at the moment a minimum of £20,000 between the two. So there's 8,000 going into my pension, which goes in, 4,000 from me and 4,000 from my employer, and then the remaining 12,000 goes into my stocks and shares ISA, which is £1,000 a month. I will likely put more than that in. I want to get my stocks and shares ISA up to the 20,000, but that's the minimum that I set myself, that I'm going to do that every year, 12,000. So it might be a little bit more. It might be 28,000 if I can get the full 20,000 in my stocks and shares allowance, or as a bare minimum, hopefully it'll continue to be 20,000 between the two pots over the next 4 years. The calculations that I've worked out, so I've done some calculations for you to give you an idea of what those pots will look like in 4 years. So obviously the only pot that I can access in 4 years is going to be my stocks and shares ISA. Now, with all the best forecasting in the world, this is a little bit of a lottery, but the estimate is with a 10% return, which I'm quite comfortable using. I know most people will use a lot lower returns than that. If the average is around 10%, I think why not use it for the next 4 years? And with that 10% return, that will get me to a pot of around £370,000. That's based on the 12,000 per year. So not, millions. A lot of people aim for £1 million, but that is the money that I will start drawing down on. And I will draw down from that. I'll tell you in a second exactly how much I'm going to draw down on that. Let's look at my pension for a second. So pension is 160,000 at the moment. I can't retire until I'm 57 at the very earliest, so I've still got quite a lot of time there to go before I can touch that money. So that'll give me another 16 years or so of growth. Just investing or just putting money in for the next 4 years, because if I do start drawing down, I probably won't be investing that amount into my pension. But if I was to leave that for the next 16 years, that would leave me with an investment balance in there of 750,000 when I am 57. So I'd be able to use that to draw down on. And that would also bridge the gap until my state pension comes into play, if that is still a thing, which will be 67, 70, God knows what age, when I can actually access my state pension. So how am I going to balance all of this so I can retire at 45? So I'm going to be super aggressive in my stocks and shares ISA. Now, a lot of you will be familiar with the 4% withdrawal rate, which is great. But the idea of the 4% withdrawal rate is that you don't run out of money. In my stocks and shares ISA, I am not concerned about diminishing that balance. I'm not concerned about running out of money. So I am happy to take a much higher withdrawal rate from that. I'm actually going to take £36,000, £3,000 per month after tax. That'll be £3,000 cash, which will be tax-free because it's in the stocks and shares ISA. And I've worked out, using the bridge calculator, if that continues to earn 10%, then that will last me and leave a balance in there, a significant balance in there, till 57. So I'm going to take 10% from my stocks and shares ISA when I turn 45. Now, a lot of you will say that's crazy. What happens if there's poor returns? What happens, there's all these what ifs, and these are all fair and genuine questions, right? But I'm happy to be aggressive, because if something comes up, if the stock market falls off a cliff like it did in 2008, there's things I can do to mitigate that risk. I can take less money for a short period of time. I don't necessarily need that all of the time. I could also go back to work. I can get a job. I can start earning some money. I've also got an emergency fund of cash put aside. So I do have cash there. So if the stock market has a wobble and it drops massively, 10, 20, 30, 40% in that period, I don't need to take money out of there as well. And all of those things leave me really confident to take, what is almost 10% out of that stocks and shares ISA at 45. And then when I get to 57, hopefully I'll still have, a significant chunk left in my stocks and shares ISA, and I'll have £750,000 in my pension. That'll mean that I can start to take 4% or a more typical number from that amount, but also bearing in mind that I've got the state pension coming. My wife and I will both have that. So hopefully that'll be a significant part of the money that we need. The big thing that I'm actually more worried about than running out of money, because I'm not concerned about that. I am super aggressive in this modelling. I actually spoke to a financial advisor recently who said, you're fine to do that. We can't be aggressive. Even if I thought that was the smart move for you, we can't recommend that. He almost alluded to the fact that, this could be a more sensible model, because I don't want to die the richest man in the graveyard, which is where we are today. I want to make sure that I use every penny I've got to live the best life possible. And I read the book Die with Zero by Bill Perkins, and that really resonated with me. Things like giving my kids money now while I can afford to do it, rather than wait until I'm dead and gone and they get a nice little windfall and have to worry about things like, capital gains tax, inheritance tax. So I want to be super aggressive, because I don't want to die with lots of money. So that's my plan: retire at 45. I may not retire. It's just going to give me the financial freedom to do what I want. I'm going to talk on the channel about this journey over the next 4 years. I'm also going to talk about some of the side hustle things I'm doing, like this YouTube channel, because I'm a little bit more free now than what I used to be. And I'm going to start sharing this journey. So if that sounds like something you're interested in, subscribe, comment, and follow the journey. And hopefully I'll see you on the next one.